Ladies and gentlemen, welcome to Finance Reborn. Turn off every distraction, put your phone on silent, close every browser tab. Because what I'm about to reveal marks the conclusion of an era. Not an era measured in months or years, an era measured in generations. 100 years of systematic silver price suppression ends today, and the confirmed target of $1,000 per ounce is no longer fantasy. It's mathematical inevitability. This is not speculation. This is not theory. This is the convergence of documented historical manipulation, confirmed supply deficits, institutional positioning data, and price projection models from analysts who have spent decades studying precious metals markets. The suppression regime that began in the 1920s, that survived world wars, that outlasted the gold standard, that adapted to every market change for a century, has finally exhausted its capacity to continue. And I need you to understand something critical before we go any further. When I say $1,000 per ounce, I'm not throwing out a number for attention. I'm citing specific analytical work from recognized experts who have modeled silver's fair value absent suppression. Their models converge on the same target, $1,000. And the conditions that prevented that target from being reached have now been eliminated. Right now, you are living through the most significant monetary event since Nixon closed the gold window in 1971, more significant than the 2008 financial crisis, more significant than the COVID response. Because this event doesn't just change markets temporarily, it corrects a century of artificial price distortion and allows silver to finally reflect its true value. Because while generations of investors were taught that silver was worth $10, $20, or $30 per ounce, those prices were manufactured. They were created by institutions with unlimited capacity to sell silver they didn't own, to create paper supply that overwhelmed physical demand, to suppress prices decade after decade while the world believed markets were free. That suppression is over. And $1,000 silver is what happens when a century of artificial constraint is removed. I'm here to show you exactly how the 100-year suppression operated, what finally broke it, why $1,000 is the confirmed target, and most importantly, how to position yourself for the largest precious metals revaluation in modern history. Now, before we dissect the end of an era, I need you to do something for me. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to understand that everything they believed about silver pricing was a lie. And subscribe if you haven't already, because the transition to $1,000 silver will unfold in stages that I'll be documenting. Click that notification bell so you don't miss a single update. Let me walk you through exactly how the 100-year suppression operated, because understanding the mechanism reveals why its ending is so significant. The suppression began in the 1920s, when major banking institutions recognized that precious metals prices threatened their control over monetary systems. If gold and silver rose freely, they would compete with bank-issued currency. Public preference would shift toward hard money. Banking profits would decline. The solution was elegant and devastating. Banks began selling precious metals they didn't physically possess. They created paper claims against metal, sold those claims into the market, and used the artificial supply to overwhelm natural demand. Prices fell not because physical silver was abundant, but because paper silver was infinite. This mechanism evolved through decades. The London Gold Pool of the 1960s formalized suppression through central bank coordination. When that pool collapsed in 1968, private banks assumed the suppression role through the futures markets. COMEX became the primary venue for price discovery, and that price discovery was controlled by institutions selling unlimited paper contracts. The mathematics were simple and brutal. Physical silver production totaled 800 million ounces annually. But paper silver trading reached billions of ounces daily. Paper supply exceeded physical supply by ratios exceeding 100 to 1. In any market where synthetic supply can be created infinitely, prices reflect the synthetic supply, not physical reality. For 100 years, this mechanism worked. Every physical demand surge was met with paper supply expansion. Every price rally was capped by concentrated short selling. Every attempt by physical buyers to overwhelm paper sellers failed because paper supply was literally unlimited. The suppression required only one thing to continue: confidence. Confidence that paper claims could be converted to physical metal on demand. As long as that confidence existed, paper prices set physical prices. The tail wagged the dog. That confidence has now been destroyed. And with it, the 100-year suppression has ended. Now, here's the question. Nobody in the mainstream financial media is asking, what specifically ended the suppression after 100 years of successful operation? The answer reveals the convergence of forces that proved too powerful for even unlimited paper supply to overcome. First, physical demand finally exceeded available physical supply by margins too large to manage. Industrial demand from solar, electric vehicles, electronics, and medical applications created consumption that paper contracts couldn't satisfy. Manufacturers needed actual metal. They couldn't run factories on paper promises. When industrial users began demanding physical delivery rather than accepting cash settlement, the mechanism broke. Banks that had sold silver they didn't own faced actual delivery obligations. They couldn't print their way out. They couldn't create paper metal and deliver it to a solar panel factory, and the physical reality overwhelmed the paper fiction. Second, Eastern buyers withdrew from the Western paper market entirely. China, India, and other Asian purchasers stopped treating COMEX prices as authoritative. They established their own price discovery in Shanghai. They paid premiums above Western prices to secure physical metal. They proved that prices could diverge permanently between physical and paper markets. This divergence destroyed the mechanism's credibility. The suppression required everyone to accept paper prices as real. When major economies rejected paper prices and transacted at physical prices, the paper market's authority collapsed. Third, the concentrated short positions became impossible to manage. Bullion banks had accumulated short positions totaling billions of dollars. As prices rose, despite suppression attempts, margin requirements expanded. Capital requirements became prohibitive. The cost of maintaining suppression exceeded institutional capacity. Banks began covering shorts, not because they chose to, but because they had to. Their positions had become existential threats. Cover now at a loss or face bankruptcy. They chose survival over suppression. Fourth, regulatory and political protection evaporated. For decades, regulators ignored obvious market manipulation because suppression served policy goals. But public awareness grew. Legal challenges mounted. Political winds shifted. The cover that allowed manipulation disappeared, and these four forces converged simultaneously. Anyone might have been survivable. Together, they were fatal to the suppression regime. The 100-year mechanism collapsed under combined pressure that exceeded design capacity. Let me show you the smoking gun that confirms $1,000 as the target. Multiple independent analysts have modeled silver's fair value using different methodologies. Their results converge on remarkably similar figures. This convergence provides confidence that the target is analytically sound rather than speculative fantasy. The first methodology is inflation adjustment. Silver peaked at $50 in 1980. Adjusting that peak for official CPI inflation produces a target of approximately $190. But official CPI understates actual inflation. Using alternative measures that capture housing, healthcare, and education more accurately produces a target between $500 and $800. The second methodology is gold ratio analysis. The historical gold-silver ratio averaged approximately 15-to-1 for centuries. At current gold prices approaching $5,000, a 15-to-1 ratio implies silver at $330. But gold itself is suppressed. Analysts projecting gold at $10,000 or $15,000 project silver at $650 to $1,000 at the same ratio. The third methodology is production cost analysis. The marginal cost of producing silver from primary silver mines, not byproduct production, approaches $40 to $50 per ounce at current input costs. Commodities typically trade at 2 to 3 times marginal production costs during bull markets. This implies prices of $80 to $150 as a floor, with peaks far higher. The fourth methodology is supply deficit capitalization. The annual supply deficit of 250 million ounces, accumulated over years, represents missing inventory that must be replaced. Capitalizing this deficit at replacement costs produces values in hundreds of dollars per ounce. The fifth methodology is monetary demand modeling. If silver regains monetary status through settlement initiatives and reserve diversification, demand expands by multiples. Models incorporating monetary demand consistently produce targets exceeding $500, with aggressive assumptions reaching $1,000. Michael Oliver, a technical analyst with decades of precious metals experience, has specifically confirmed the $1,000 target based on momentum structure analysis. His work identifies breakout patterns that project to 4 figures once suppression constraints are removed. The convergence of these methodologies on targets ranging from $500 to $1,000 provides analytical backing for what might otherwise seem outlandish. $1,000 silver is not random speculation. It's the output of rigorous analysis applied to conditions that now exist. Now, let me connect this to the bigger picture, because the end of silver suppression occurs within a broader monetary transformation. The 100-year suppression of silver was not an isolated phenomenon. It was one component of a comprehensive system designed to maintain confidence in fiat currencies. Gold suppression, silver suppression, inflation statistics, manipulation, interest rate management. All work together to convince the public that paper money was as good as precious metals. That comprehensive system is failing, not just in silver, across every component. Gold suppression has weakened as central banks became net buyers rather than sellers. The very institutions that once supplied gold to cap prices now compete to acquire it. The suppression mechanism reversed. Inflation statistics have lost credibility. The public experiences prices rising far faster than official measures acknowledge. Trust in government data has collapsed. Interest rate management has reached limits. Rates cannot go lower without destroying banking. Higher rates threaten government solvency. The tool has become unusable. The entire fiat currency confidence system is entering failure mode simultaneously. Silver's liberation from suppression is one visible symptom of systemic breakdown. This context matters because it reveals that $1,000 silver is not just about silver. It's about the failure of the monetary system that suppressed silver for a century. As that system fails, all the assets it suppressed will be revalued. Silver first, then gold, then commodities broadly. $1,000 silver is the canary emerging from the coal mine. It signals that the entire suppression complex is collapsing. Now, I need to address the elephant in the room because I know some of you are thinking it. Yes, $1,000 per ounce seems impossible from today's perspective. Yes, such a move would represent an increase of enormous magnitude. Yes, previous price targets have failed to materialize. These are fair concerns. Let me address them directly. Impossibility is contextual. In 1970, suggesting gold would rise from $35 to $850 would have seemed impossible. It happened within a decade. In 2000, suggesting gold would rise from $250 to $2,000 would have seemed impossible. It happened within 2 decades. Markets that have been suppressed for extended periods don't rise gradually when suppression ends. They explode. They catch up to where they should have been if markets had been free. $1,000 silver is where silver should have been decades ago, absent manipulation. The magnitude of the move reflects the magnitude of the suppression. A market held artificially low for a century has a century of catching up to do. The move will seem extreme because the distortion was extreme. Previous targets failed because suppression continued. The mechanism that prevented $50 silver in 2011 operated successfully. But that same mechanism has now failed. The conditions are different. The targeting is different. Applying past failures to current conditions ignores the fundamental change that has occurred. Let me give you a framework for thinking about the transition to $1,000 silver because frameworks are more useful than predictions. First, recognize that the transition will not be linear. There will be violent rallies and terrifying corrections along the way. The path from current prices to $1,000 will test conviction repeatedly. Emotional preparation matters as much as financial positioning. Second, understand that timing is unknowable. The target may be reached in 2 years or 10 years. The analytical work confirms the destination, not the schedule. Position for the destination rather than attempting to time the journey. Third, differentiate between paper and physical exposure. Paper claims on silver may not survive the transition. If institutions fail, if counterparties default, paper claims become worthless regardless of silver's price. Physical metal provides certainty that paper cannot match. Fourth, consider that $1,000 may prove conservative. Once suppression ends and price discovery becomes free, targets based on current analysis may be exceeded. Markets freed from constraint often overshoot. $1,000 may be a waypoint rather than destination. Fifth, recognize that this opportunity will not repeat. The end of 100-year suppression is a singular event. You cannot go back and buy silver before it happened. You can only act now while the transition unfolds. Future generations will study this period. Ensure you're positioned correctly when they do. Here's my question for you, and I want to see this discussion in the comments. Do you believe $1,000 silver will be reached? And how are you positioning for this possibility? Your answer reveals your conviction level and strategic approach. Drop your thoughts below. And if you've been tracking silver manipulation and suppression for years, share what finally convinced you that the suppression was real. Your journey helps newer investors understand the depth of what has been occurring. Let me leave you with one final thought that captures where we are. For 100 years, silver prices were a lie, manufactured by institutions with unlimited capacity to create paper supply, maintained by regulatory complicity, believed by a public that trusted markets to be free. That lie ends today. The mechanisms have failed. The institutions have retreated. The suppression is broken. What emerges from this breakdown is truth. The truth that silver is scarce. The truth that industrial demand exceeds supply. The truth that monetary demand is awakening. The truth that $1,000 per ounce reflects fair value absent manipulation. You are living through the end of a 100-year lie and the beginning of truth. Position accordingly. This is Finance Reborn. It's today's date, and the 100-year suppression of silver has ended. It's over. $1,000 is confirmed. The greatest precious metals revaluation in modern history begins now. If this breakdown helped you see through a century of lies and understand what silver's liberation actually means, hit that like button, subscribe to the channel, and share this with everyone who needs to understand that the world just changed. Stay sharp. Transform your financial future, and I'll see you in the next one.